Imagine waking up tomorrow to find your bank account closed, not frozen pending investigation, not limited while they verify something. Closed. Gone. Your paycheck that was supposed to direct deposit today bounced back, the rent check you wrote will fail, your debit card stops working, and when you call the bank, frantically trying to understand what happened, they tell you they've decided to end the relationship but won't explain why. They'll mail you a check for your balance in 7 to 10 business days, assuming your address is current. Until then, you have no access to your money, no way to pay bills, no way to buy groceries, and when you try to open an account at another bank, you discover that you've been flagged in banking databases as a risk, making it difficult or impossible to get another account anywhere. This isn't a dystopian hypothetical. It's happening to thousands of people right now, in America and across the developed world, as banks exercise power they've quietly accumulated to exclude people from the financial system entirely. This is called debanking, and it's just one way that institutions you trust with your money can suddenly turn against you, deciding that you're too risky, too controversial, or just too much trouble to keep as a customer. But it goes deeper than individual account closures. Banks have also secured legal authority, ratified in multiple countries after the 2008 financial crisis, to confiscate depositor funds to bail themselves out during crises. They can freeze accounts without explanation. They surveil your transactions and report you to government agencies based on patterns they won't disclose. And they operate increasingly as gatekeepers who decide which businesses, which industries, which political movements, and which individuals get access to the financial system and which get excluded. Understanding when and why banks turn against you means recognizing that your relationship with your bank isn't what you think it is, that your deposits aren't really yours in the way cash under a mattress would be, and that the financial system has become a choke point for political and social control that goes far beyond anything its creators intended or the public understands. Winston Saussure. The term debanking entered public consciousness relatively recently, but the practice it describes has been growing for over a decade. Debanking, also called de-risking, occurs when banks close customer accounts, refuse to open new accounts, or restrict services for customers they deem too risky. The stated reasons usually involve compliance concerns, money laundering risks, reputational damage, or regulatory pressure. But increasingly, debanking appears to target legal businesses and individuals based not on actual financial crimes but on political views, industry sectors that regulators disfavor, or associations that banks find inconvenient. The practice accelerated dramatically after the 2008 financial crisis when regulators, burned by the near collapse of the financial system, imposed increasingly stringent requirements on banks to monitor customers, file suspicious activity reports, and avoid reputational risk. That last term, reputational risk, became a blank check for regulators to pressure banks into closing accounts of any customer whose business or politics might generate negative publicity, regardless of whether the customer had violated any law. If a bank served clients in industries like firearms, marijuana, even in states where it's legal, cryptocurrency, short-term lending, or adult entertainment, regulators could cite reputational risk and pressure the bank to exit those relationships. And because banks face enormous regulatory power and the threat of enforcement actions, consent decrees, and penalties that could cost billions, they often complied, quietly closing accounts and refusing to explain why. Fox Business porn Operation Chokepoint, launched by the Obama administration's Department of Justice in 2013, formalized this approach. The initiative explicitly targeted legal businesses in industries regulators deemed undesirable, applying pressure on banks to close accounts or deny services to those businesses. The stated goal was preventing fraud, but the practical effect was cutting off entire legal industries from the banking system based on regulatory preferences rather than law. Gun dealers, payday lenders, tobacco sellers, and others found themselves unable to maintain bank accounts, not because they'd committed crimes, but because the DOJ had designated their industries as high risk and banks, fearing regulatory retaliation, refused to serve them. The framework established through Operation Chokepoint and subsequent regulatory guidance created what critics called a financial swamp, where unelected regulators effectively decided which businesses could access banking and which couldn't. And because modern commerce requires banking, you can't run a business paying employees, accepting payments, or managing cash flow without a bank account. Being debanked effectively meant being forced out of business. The power to debank became the power to destroy livelihoods without trial, without formal charges, and without the due process that criminal prosecution would require, By the 2020s, debanking had expanded beyond controversial industries to include individuals whose political views or associations banks found problematic. Conservative activists, cryptocurrency entrepreneurs, and even relatives of political figures found their accounts closed without explanation. Melania Trump disclosed in her memoir that her bank account was closed after years with the institution and that Barron Trump was denied the ability to open an account after January 6, 2021. Cryptocurrency companies faced systematic debanking, with multiple banks closing accounts for businesses operating in the entirely legal crypto industry simply because regulators viewed crypto as risky or undesirable. And activists on both left and right found themselves debanked after participating in protests or expressing views that banks or regulators considered inflammatory. The mechanics of debanking reveal how banks turned from service providers into gatekeepers exercising political and social control. When a bank decides to close your account, you typically receive minimal notice, often just a letter stating that the bank has decided to end the banking relationship and that you have 30 days to move your funds elsewhere. The bank is prohibited by law from explaining if the closure relates to a suspicious activity report, a SAR, filed with the Financial Crimes Enforcement Network. SARs are confidential reports banks must file when they detect transactions they consider suspicious, even if those transactions are legal and even if the suspicion is unfounded. If a bank files a SAR on you, it can't tell you because telling you would violate the confidentiality requirements of the Bank Secrecy Act. This creates a Kafkaesque situation where you can be flagged as suspicious, have your account closed because of that suspicion, and never be told why or given any opportunity to explain or contest the findings. All the available evidence suggests the majority of SARs are filed on innocent people who've done nothing wrong. Unusual deposit patterns, large cash transactions, foreign wire transfers, any of these can trigger SARs even when they're completely legal and have benign explanations. But the SAR goes into your record anyway. And if you accumulate enough SARs, even if you're completely innocent of any wrongdoing, banks face regulatory pressure to close your account. The legal and regulatory incentives push banks toward debanking anyone who generates paperwork or might attract scrutiny, even if that scrutiny would reveal no actual wrongdoing. Making the situation worse, being debanked at one bank often makes it impossible to get an account elsewhere. Banks share information through databases that flag individuals and businesses that have been closed or denied. Once you're in those databases, other banks see you as a risk and refuse to open accounts for you. This creates a cascading exclusion where one account closure, potentially based on nothing more than algorithmic flagging of legal transactions, results in complete exclusion from the banking system. And because the reasons for closure are secret, you have no way to correct errors or prove your innocence. You're just cut off, left to operate in an increasingly cashless society without access to basic banking services. The scale of debanking is difficult to measure precisely because banks don't publicly report account closures and regulators don't publish comprehensive data. But investigations suggest the problem is widespread and growing. A congressional report issued in December 2025 documented systematic debanking of cryptocurrency companies and found that federal regulators had actively pressured banks to exit the crypto sector regardless of individual company compliance records. The report revealed that regulators used informal guidance and examination pressure to push banks toward debanking entire industries operating outside formal rulemaking processes that would require public notice and comment. The Trump administration, responding to debanking complaints including from Trump family members who'd been debanked, issued an executive order in August 2025 titled Guaranteeing Fair Banking for All Americans. The order directed federal banking regulators to remove reputational risk concepts from guidance and examination materials, investigate banks that engaged in political or religious debanking, impose fines and penalties for improper debanking, and require the Small Business Administration to identify and remediate clients denied services due to debanking. The order gave regulators 180 days to implement these changes and directed them to refer cases of religious-based debanking to the Attorney General for civil enforcement. The regulatory response has been swift but controversial. The OCC issued bulletins reminding banks of their obligations to protect customer financial records and clarifying how the agency would consider debanking and licensing and Community Reinvestment Act evaluations. The CFPB directed enforcement attorneys to review investigations from the past 5 years for evidence of account closures based on religion, political beliefs, or lawful business activities. And the Small Business Administration sent letters to over 5,000 lenders requiring them to identify debanking policies and reinstate affected clients by specific deadlines. These actions signal a dramatic shift in government policy toward debanking, from tacit encouragement under previous administrations to active prohibition under the current one. But the fundamental problem remains. Banks still face enormous pressure from anti-money laundering regulations, Bank Secrecy Act requirements, and examination standards that effectively require closing accounts once multiple SARs have been filed. Current AMLBA requirements mandate account closures on a risk-assessed basis, creating tension between regulatory anti-debanking directives and the existing compliance framework that generates debanking. Examiners still expect accounts with multiple SARs to be closed, meaning banks that keep those accounts open face regulatory criticism for inadequate risk management. The result is that banks remain caught between competing regulatory mandates. Don't debank based on politics or religion, but do close accounts that generate too many red flags, even if those flags are false positives on innocent customers. Debanking is just one way banks can turn against you. More dramatic and potentially devastating are bail-ins. The power banks now have to confiscate depositor funds to recapitalize themselves during crises. Most people remember the 2008 financial crisis and the controversial bank bailouts where governments used taxpayer money to rescue failing banks. The public outrage over those bailouts led to a different approach in subsequent crises. Instead of taxpayers bailing out banks, depositors would bail in banks by having their deposits converted to bank equity. The template for bail-ins was established in Cyprus in March 2013 when the country's banking system faced collapse. The Cypriot government, under pressure from European authorities and unable to afford a traditional bailout, agreed to a plan where depositors with more than $100,000 in Bank of Cyprus and Laiki Bank would have their deposits above that threshold confiscated to recapitalize the banks. The confiscation, presented as a temporary conversion to bank shares that depositors could theoretically sell later, was actually permanent for most because the shares were worthless. Depositors at Bank of Cyprus lost 47.5% of their uninsured deposits, money they'd saved for retirement, for their children's education, for their businesses, simply taken overnight to pay for bank failures they had no role in causing. The Cyprus bail-in shocked the world and seemed like a one-off event driven by that country's unique circumstances. But it wasn't. The framework for bail-ins had already been built into financial reform legislation passed after 2008. The Dodd-Frank Act in the United States and similar legislation in Europe gave regulators authority to use orderly liquidation procedures that could include converting unsecured debt and even deposits into bank equity during resolution of failing institutions. The specifics vary by jurisdiction, but the principle is the same. When banks fail, the cost will be borne first by shareholders, then by bondholders, then by large depositors rather than by taxpayers. This sounds reasonable until you realize what it means in practice. Your bank deposit isn't really your money held safely by the bank. It's a loan you've made to the bank, and like any loan, it can be written down or converted to equity if the borrower, the bank, fails. The FDIC insurance protects deposits up to $250,000, but any amount above that limit is unsecured and at risk. For individuals with large savings, for businesses with payroll and operational funds, for anyone holding deposits above the insured limit, the bank can effectively confiscate those excess funds during resolution, converting them to shares in a failed bank that are likely worthless. Making this more concerning, bail-in powers can be exercised over weekends when banks are closed and depositors have no opportunity to withdraw funds. The Cyprus bail-in happened on a Friday night with banks closed until the following Tuesday, preventing depositors from accessing their money before the confiscation took effect. And the decision was made by technocrats and politicians, not by courts or due process that would give depositors any opportunity to contest the action. If regulators decide your bank is failing and needs to be resolved, they can take your uninsured deposits instantly, without warning, without consent, and without any meaningful recourse. Bail-in authority exists now in most developed countries. The European Union's Bank Recovery and Resolution Directive explicitly establishes bail-in as the preferred method for resolving failed banks. The Financial Stability Board, an international body coordinating financial regulation, has endorsed bail-in frameworks as best practice, and multiple countries have implemented legislation giving their regulators bail-in powers. This means that depositors everywhere face the risk that their savings above deposit insurance limits can be confiscated if banks fail, a risk most people are completely unaware of because it's buried in complex financial legislation and rarely discussed in media coverage. Capital controls represent another way banks and governments can turn against depositors, restricting or prohibiting access to your own money based on broader economic or political concerns. Argentina, Greece, Cyprus, Venezuela, and numerous other countries have imposed capital controls during financial crises, limiting how much money citizens can withdraw from banks or wire abroad. These controls are presented as temporary emergency measures to prevent capital flight and bank runs, but they often last for years and devastate people who need access to their money for legitimate purposes. In Greece during the 2015 debt crisis, banks closed for weeks and ATM withdrawals were limited to $60 per day. Businesses couldn't pay suppliers, individuals couldn't access their savings, and the elderly, who often kept larger sums in banks rather than investing in markets, found themselves impoverished overnight despite having substantial deposits because those deposits were inaccessible behind closed bank doors. When banks finally reopened, controls remained in place for years, strictly limiting transfers abroad and wire transfers, effectively trapping money in the Greek banking system, and preventing capital from leaving even when depositors desperately wanted to move funds to safer jurisdictions. The United States has never imposed widespread capital controls, but the legal authority exists. The International Emergency Economic Powers Act and the Trading with the Enemy Act give the President broad powers to freeze assets, restrict transactions, and control capital flows during declared emergencies. These powers are most commonly used against foreign adversaries or designated terrorist organizations, but they could theoretically be applied domestically during a severe crisis. If another financial panic struck and authorities feared mass bank runs would destroy the system, they could impose capital controls limiting withdrawals and transfers, essentially trapping depositors' money in failing institutions while claiming it's necessary to maintain financial stability. Even without formal capital controls, banks already restrict access to funds in ways most depositors don't realize. Large withdrawals often require advance notice, sometimes weeks, for amounts exceeding $10,000. Wire transfers can be delayed or blocked based on internal compliance reviews, and banks can place holds on deposits, sometimes for weeks, claiming they need to verify funds or investigate suspicious activity. These restrictions mean that money you think is liquid and available on demand often isn't, at least not in quantities that matter for major expenses or emergencies. Financial surveillance is another dimension of how banks have turned from service providers into instruments of state control. Under the Bank Secrecy Act and subsequent anti-money laundering legislation, banks must monitor all transactions and report suspicious activity to the government. This surveillance is pervasive and largely invisible to customers. Every transaction you make, every deposit, withdrawal, transfer, or payment is analyzed by algorithms looking for patterns that might indicate money laundering, fraud, tax evasion, or other financial crimes. The threshold for what triggers a suspicious activity report is deliberately vague and left to bank discretion. Deposits of $10,000 or more must be reported automatically through currency transaction reports. But SARs can be filed for any amount for any reason based on any pattern the bank finds questionable. Multiple cash deposits, even small ones, can trigger SARs under structuring rules designed to catch people breaking large transactions into smaller ones to avoid reporting thresholds. But legitimate businesses that handle cash routinely, like restaurants or small retailers, often trigger structuring alerts despite doing nothing wrong. Foreign transfers are particularly scrutinized. Sending money abroad, receiving money from foreign accounts, or making payments to recipients in certain countries can all trigger reviews and SARs. For immigrants sending remittances to family in their home countries, for people doing business internationally, or for anyone with legitimate reasons to transfer money across borders, this surveillance creates constant risk of being flagged as suspicious even when every transaction is legal and properly documented. The information banks collect through this surveillance is shared with government agencies, particularly FinCEN, the Financial Crimes Enforcement Network. FinCEN maintains a database of SARs, currency transaction reports, and other financial intelligence that law enforcement can access. While this system is intended to catch actual criminals, the low threshold for filing SARs means that millions of innocent people have reports in the database, red flags in their financial profiles that could be used against them in investigations or to justify account closures and denials of service. Privacy barely exists in banking. The Right to Financial Privacy Act provides some theoretical protections requiring government agencies to follow procedures before accessing your bank records. But numerous exceptions allow law enforcement to access records without warrants or customer notification in many circumstances. And once a SAR is filed, it becomes government property that can be accessed and used without your knowledge. The OCC's recent bulletin reminding banks to protect customer financial records acknowledges this issue, but the fundamental surveillance apparatus remains in place. Banks have also become enforcers of economic sanctions and political judgments in ways that directly affect ordinary customers. If you share a name with someone on a sanctions list, even if you're clearly not the same person, you can have transactions blocked or accounts frozen while the bank investigates. If you do business with companies or individuals in sanctioned countries or industries, even for transactions that are legal under applicable licenses and exemptions, banks often refuse to process payments rather than risk regulatory violations. And banks make these decisions with extreme conservatism, blocking legitimate transactions because it's safer to say no than to potentially face penalties for getting compliance wrong. The payment networks, Visa, MasterCard, and others, exercise similar gatekeeping power. They've cut off entire categories of legal businesses from accepting card payments based on reputational concerns or political pressure. After the January 6th Capitol riot, payment processors cut off various conservative organizations and individuals based on their perceived association with the events, even when they had no role in violence or illegal activity. And cryptocurrency services, online gambling, CBD products, and adult content creators have all faced payment processor debanking, making it difficult or impossible for them to accept electronic payments despite operating legal businesses. This financial gatekeeping power has turned banks and payment processors into arbiters of what businesses and activities are socially acceptable regardless of what the law says. They operate as a parallel regulatory system, more restrictive than actual law, driven by compliance risk aversion and susceptibility to political pressure. And because they operate through private companies rather than government, the constitutional protections that would limit government censorship or discrimination don't apply. Banks can discriminate based on political views, religious beliefs, or controversial but legal business activities in ways that government couldn't directly impose but can effectively achieve by pressuring banks to do the discriminating for them. The convergence of debanking, bail-in authority, capital controls, financial surveillance, and payment gatekeeping reveals that banks have accumulated extraordinary power over individuals' economic lives. They can exclude you from the financial system entirely. They can confiscate your deposits to rescue themselves. They can restrict your access to your own money. They can surveil every transaction you make and report you to authorities. And they can decide which businesses, political movements, or activities get financial access and which get excluded. This power was accumulated gradually, usually justified by worthy-sounding goals like preventing money laundering, terrorist financing, or financial instability. Each individual regulation or policy seemed reasonable in isolation. But the cumulative effect is a financial system where individuals have lost control over their own money and banks have gained authority to make decisions that profoundly affect people's lives without transparency, due process, or meaningful accountability. The question facing depositors is whether this system is sustainable or desirable. If banks can close your account without explanation, confiscate uninsured deposits during crises, freeze funds based on algorithmic surveillance, and deny services based on your politics or associations, do you really own your money? Or has it become something more like a privilege that banks and regulators can revoke at will? The push for central bank digital currencies, CBDCs, threatens to make these problems dramatically worse. CBDCs would give governments direct control over digital money, eliminating the intermediation that commercial banks currently provide. Every transaction would be visible to authorities in real time. Funds could be frozen, confiscated, or programmed with restrictions on how and where they can be spent. Negative interest rates could be imposed directly on holdings. And exclusion from the financial system could be as simple as a government agency flipping a digital switch to freeze your CBDC wallet. Everything concerning about current banking surveillance and control would be amplified exponentially in a CBDC system. Alternatives exist but come with their own challenges. Cryptocurrency offers the promise of financial transactions outside the traditional banking system, which is precisely why it faces such fierce regulatory hostility and systematic debanking. Physical cash remains outside surveillance and control, but is increasingly difficult to use in a society that has moved toward digital payments and where large cash transactions trigger reporting requirements. And offshore banking, moving money to jurisdictions with better privacy protections, is expensive, requires navigating complex regulations, and faces increasing restrictions as governments coordinate to prevent capital flight. The most fundamental alternative is political, demanding that banks be regulated as utilities rather than as private companies with discretion to deny service. If banking is essential to modern economic life, and it is, then perhaps access to banking should be guaranteed as a right rather than a privilege that banks can revoke. This would require legislation prohibiting debanking except for actual illegal activity proven through due process, not suspicion or association. It would require eliminating bail-in authority and guaranteeing that deposits are genuine liabilities protected from confiscation. And it would require limiting financial surveillance to investigations of actual crimes rather than the dragnet monitoring of every transaction by everyone. But such reforms face enormous opposition from banks that profit from current arrangements and from regulators who've grown accustomed to using financial choke points to achieve policy goals without going through the legislative process. The power to debank, to surveil, to confiscate deposits, and to control financial access is too useful to those who have it for them to give it up without a fight. And most depositors remain unaware of how the system actually works, assuming their money is safe and their banking relationship secure until the day they're not. Understanding when banks turn against you means recognizing that the relationship between depositors and banks has fundamentally changed. You're not a customer to be served, but a risk to be managed, a regulatory liability to be monitored, and increasingly, a subject whose behavior can be influenced or controlled through the threat of financial exclusion. The banks you trust with your money have become enforcers of a surveillance system, gatekeepers to economic participation, and holders of legal authority to confiscate your deposits when convenient. This isn't the banking system we were promised or that most people think they're participating in. It's something new and concerning, built piece by piece through regulations and policies that seemed reasonable individually but collectively have created an architecture of financial control that would have been unthinkable a generation ago. And unless depositors demand changes, unless people recognize how much power banks have accumulated and insist on restoring balance, the system will only become more restrictive, more surveillance-heavy, and more willing to exclude those who don't conform to the narrow standards banks and regulators impose. If this gave you a new perspective, hit subscribe. History doesn't repeat, but power always concentrates. And the power banks have over your money, your livelihood, and your economic freedom is growing every day, quietly, legally, and with almost no one paying attention until it's their account that gets closed, their funds that get frozen, their life that gets upended because the bank decided you were too much trouble or too controversial to keep as a customer. The banks have turned, not against society generally, but against individuals who find themselves on the wrong side of algorithms, politics, or bureaucratic convenience. And by the time you discover you're one of those individuals, it's already too late to protect yourself. The account is closed, the money is gone, and the bank isn't answering your calls because they don't have to. They never did. You just didn't realize it until they turned against you.